This is Cost and Management Accounting, an introductory lesson series. My name is Huijun Chen. I'm from the Department of Accounting and Information Systems, College of Management at Asia University. Lesson 3, Job Order Costing, Cost Flows and External Reporting. Do you still remember job order costing, absorption costing, allocation base, predetermined overhead rate, overhead application, and normal costing? To start this lesson, we are going to review the key terms first. Job order costing is a costing system used in situations where many different product jobs or services are produced each period. Absorption costing is a costing method that includes all manufacturing costs, direct materials, direct labor, and both variable and fixed manufacturing overhead in the cost of a product. Allocation base is a measure of activity, such as direct labor hours or machine hours, that is used to assign costs to cost objects. Predetermined overhead rate is a rate used to charge manufacturing overhead costs to jobs that is established in advance for each period. Overhead application is the process of assigning overhead costs to specific jobs using the following formula. Overhead applied to a particular job is equal to predetermined overhead rate times amount of allocation base incurred by the job. While normal costing is also a costing system in which overhead costs are applied to a job by multiplying a predetermined overhead rate by the actual amount of the application base incurred by the job. As we have reviewed the key terms, we will start learning objectives number 1 and number 2 together. Learning objectives number 1 is to understand the flow of cost in the job order costing system and prepare appropriate journal entries to record costs. Learning objective number 2, we will use the account to show the flow of costs in a job order costing system. Please remember, raw materials include any materials that go into the final product. We will use RM to represent raw materials in the following section. Work in process consists of units of production that are only partially complete and will require further work before they are ready for sale to customers. We will use WIP to represent work in process. This WIP. Finished goods, or FG, consist of completed units of product that have not been sold to customers, while the cost of goods manufactured, or COGM, includes the manufacturing costs associated with the goods that were finished during the period. This is a conceptual overview to show the flow of costs to the financial statements, including balance sheet and income statement. Balance sheet is here and income statement is here. For the purpose of preparing financial statement, costs are classified into product cost and period cost. Product costs include raw materials purchase, direct labor, and manufacturing overhead. When raw materials were purchased, the cost goes to raw materials inventory under balance sheet. When the production process starts, direct labor and manufacturing overhead costs will incur. These two costs will go to work in process inventory under balance sheet. Once the goods were completed, the cost of goods manufactured will be transferred to finished goods inventory. When the goods were sold, the cost of goods sold will go to income statement. In order to sell the goods, Period costs such as selling and administrative expense will incur. These costs will expand at the period they incur and be transferred to selling and administrative expenses under income statement. To illustrate the cost flows within a job order costing system, we will record Roger Corporation's transactions for the month of April. Roger is a producer of gold and silver commemorative medallions, and he worked on only 2 jobs in April. Job A is the special minting of 1,000 gold medallions commemorating the invention of motion pictures. Was started during March and completed in April. As of March 31st, Job A had been assigned $30,000 in manufacturing cost, which corresponds with Roger's work in process balance on April 1st of $30,000. Job B is an order for 10,000 silver medallions commemorating the fall of the Berlin Wall. Was started in April and was incomplete at the end of the month. Here are the T accounts for the purchase of raw materials. When direct raw materials were purchased, you will debit raw materials and credit maybe accounts receivable or cash. When indirect materials were purchased, you will debit manufacturing overhead and credit raw materials. When the raw materials were put into production, you will debit direct materials under WIP and credit raw materials. On April 1st, Roger Corporation had 7,000 in raw materials on hand. During the month, the company purchased on account an additional 60,000 in raw materials. So, you will debit raw materials and credit accounts receivable by $60,000. During April, materials requisition forms were prepared to authorize withdrawing 52,000 in raw materials from the storeroom for use in production. These raw materials included 50,000 of direct and 22,000 of indirect materials. The following journal entry records issuing the materials to the production departments. So, you debit work in process by $50,000, which is direct material. And you also debit manufacturing overhead by $2,000, that is indirect material used. So the material accounts will be reduced by $52,000. Let's review the T accounts for purchased raw materials to see if you understand. When the raw material were purchased, you will debit raw material under this account. But when indirect materials were purchased, you will debit manufacturing overhead and credit raw materials. That is the difference for direct and indirect materials. When the direct materials were put into production, you will increase work in process and reduce your raw materials. That means you debit work in process, direct materials, and credit raw materials. Here are the T accounts for recording direct labor or indirect labor cost. We have salaries and wages payable. We also have a work in process and manufacturing overhead. When the production process starts, you will put direct labor cost into work process. So you debit work in process by the salary you paid to the direct labor, and you also credit salaries and wages payable. When indirect labor costs incur, you debit manufacturing overheads by the amount you paid to the indirect labor and credit salaries and wages payable for this indirect labor. So the treatment is the same for both direct materials and direct labor. In April, the employee times tickets, which provide hourly summaries of each employee's activities throughout the day, included 60,000 recorded for direct labor and 15,000 for indirect labor. The following entry summarizes this cost. So you debit work in process by $60,000, which is the direct labor. You also debit manufacturing overhead by $15,000, which is indirect labor, and you credit salaries and wages payable by $75,000. Here is the T account for recording other overhead. When other overhead incurs, you will debit manufacturing overhead by the actual amount. Assume that Rogers Corporation incurred the following general factory costs during April. Number 1, utilities, including heat, water, and power for $21,000. Number 2, rent on factory equipment by $16,000. Number 3, miscellaneous factory overhead costs by $3,000. When these other overhead costs incurred, you will debit manufacturing overhead by the $40,000, which is 21 plus 16 plus 3, and you will credit accounts receivable by the same amount. Accounts such as cash may also be credited. Here is the T account to show you how to apply manufacturing overhead costs to work in process. You debit overhead applied to work in process and you credit overhead applied to manufacturing overhead. Please remember, if actual and applied manufacturing overhead are not equal, a year-end adjustment is required. Assume that Rogers Corporation's predetermined overhead rate is 6 per machine hour. Also assume that during April, 10,000 machine hours were worked on job A and 5,000 machine hours were worked on job B, so a total of 15,000 machine hours used. Thus, 90,000 in overhead cost, which is $6 per machine hours times 15,000 machine hours, $90,000. These $19,000 will be applied to work in process. The following entry records the application of manufacturing overhead to work in process. You debit work in process by $90,000 and you also credit manufacturing overhead by the same amount. We've already talked about manufacturing costs and how to treat these manufacturing costs. They include direct labor, direct material, and manufacturing overhead. But how to account for non-manufacturing costs? Non-manufacturing costs are not assigned to individual jobs. Rather, they are expensed in the period incurred. Non-manufacturing costs include salary expense, depreciation expense, and advertising expenses. These are called period costs. They should be expensed at the period they incur, which means you will record this under expenses account. You don't inventorize these expenses. Roger Corporation incurred $30,000 in selling and administrative salary costs during April. The following entry summarizes the accrual of those salaries. You debit salaries expense and credit salaries and wages payable by $30,000. This one is for depreciation. Depreciation on office equipment during April was $7,000. The entry is as follows. You debit depreciation expense and you credit accumulated depreciation by $7,000. Now the next one is the advertising expenses. Advertising was $42,000 and other selling and administrative expenses in April totaled $8,000. The following entry records these items. You debit advertising expense by $42,000. You also debit other selling and administrative expense by $8,000. Together, you credit accounts payable by $50,000. Please also be noted that other accounts such as cash may also be credited if you pay by cash. This is the T account for transferring completed jobs from work in process to finished goods. Cost of goods manufactured include direct materials, direct labor, and overhead applied. This cost of goods manufactured will be transferred to finished goods once all the production process has been finished. Job A was completed during April and Job B was incomplete at the end of the month. Thus, the following entry transfers the cost of Job A from work in process to finished goods. You debit finished goods and you credit work in process by $158,000. Because Job B was not completed by the end of the month, its assigned costs will remain in work process and carry over to the next month. If a balance sheet were prepared at the end of April, the cost accumulated thus far on Job B, which is $72,000, would appear in the asset account work in process. When the finished goods were sold, you will debit cost of goods sold and credit finished goods by the same amount. For Roger Corporation, we will assume 750 of the 1,000 gold medallions in Job A were shipped to customers by the end of the month for total sales revenue $225,000. Because 1,000 units were produced and the total cost of the job from the job cost sheet was $158,000, the unit product cost was $158,000. The following journal entries will record the sale. Please be noted that all sales were on account. So, you debit account receivable and credit sales by $225,000, which is the sales revenue. You also debit the cost of goods sold and credit finished goods by $118,500. This is the cost of goods manufactured for those you sell. Learning objective number 3, to prepare schedules of cost of goods manufactured and cost of goods sold and an income statement. This slide presents a T account model of the flow of manufacturing costs in a job order costing system. This model can be very helpful in understanding how manufacturing costs flow through a normal costing system and end up as a cost of goods sold on the income statement. Please take a look at the manufacturing overhead account. A debit balance means manufacturing overhead was under-applied, while a credit balance means manufacturing overhead was over-applied. This is the schedule of cost of goods manufactured and the cost of goods sold in T accounts. If you would like to get the balance for cost of goods manufactured, you can get the beginning inventory for work in process plus direct material used plus direct labor plus manufacturing overhead applied, and then minus ending inventory for work in process. You will get a balance of COGM. Then the COGM will be transferred to finished goods. And then if you take beginning inventory for finished goods plus this cost of goods manufactured just transferred in minus ending inventory for finished goods, you will get the balance for cost of goods sold. This yellow part, direct material used, direct labor, and manufacturing overhead applied, are called total manufacturing costs added to production in the period. Beginning inventory plus cost of goods manufactured, you will get the costs of goods available for sale. This is a detailed schedule of cost of goods manufactured for Raja Corporation. As we just mentioned, direct material used in production, direct labor, and manufacturing overhead applied to work in process are called total manufacturing costs added to production. This total manufacturing costs added to production plus beginning work in process inventory is equal to total manufacturing costs to account for. Then you deduct ending work in process inventory, you will get cost of goods manufactured. Next is a detailed schedule of cost of goods sold for Raja Corporation. Beginning finished good inventory 8 cost of goods manufactured from the previous slide is equal to cost of goods available for sale. Deduct ending finished goods inventory, you will get unadjusted cost of goods sold. Please remember that we have to check whether we over-apply or under-apply manufacturing overhead. We will add under-applied overhead or deduct applied overhead. Then you will get the adjusted cost of goods sold. Please be noted that under-applied overhead is added to cost of goods sold. If overhead were over-applied, it will be deducted from cost of goods sold. As we've done the schedule of cost of goods manufactured and the cost of goods sold, we then can prepare income statement. Income statement starts from sales. Sales minus cost of goods sold will get gross margin, and then deduct selling and administrative expenses such as salary, depreciation, advertising, and other expenses. You will get net operating income. Concept check number 1. Beginning raw materials inventory was $32,000. During the month, $276,000 of raw material was purchased. Account at the end of the month revealed that $28,000 of raw material was still present. What is the cost of direct material use? Please do it now. Number C, $280,000. This is the answer. You take beginning raw materials plus raw materials purchased. You will get raw materials available for use in production minus ending raw materials inventory. Then you will get raw materials used in production. Concept check number 2. Direct materials used in production totaled $280,000. Direct labor was $375,000 and $180,000 of manufacturing overhead was added to production for the month. What were total manufacturing costs incurred for the month? The answer is B, $35,000. You take direct materials plus direct labor plus manufacturing overhead applied. You will get manufacturing costs incurred for the month. Concept check number 3. Beginning work in process was $125,000. Manufacturing costs added to production for the month were $85,000. There were $200,000 of partially finished goods remaining in work process inventory at the end of the month. What was the cost of goods manufactured during the month? The answer is C, $760,000. You take beginning work in process inventory plus manufacturing costs incurred for the period. That will be equal to total work in process during the period minus ending work in process inventory, then you will get cost of goods manufactured. Concept check number 4. Beginning finished goods inventory was $130,000. The cost of goods manufactured for the month was $760,000, and the ending finished goods inventory was $150,000. What was the cost of goods sold for the month? The answer is B, $740,000. You take the beginning finished goods inventory, $130,000, plus the cost of goods manufactured for the month, that's $760,000, then minus ending finished goods inventory, $150,000, you can get $740,000. That is the answer for this one. Learning objective number 4 is to compute under-applied or over-applied overhead costs and prepare the journal entry to close the balance in manufacturing overhead to the appropriate accounts. Here are the key concepts. The difference between the overhead costs applied to work in process and the actual overhead costs of a period is referred to as either under-applied or over-applied overhead. Under-applied overhead exists when the amount of overhead applied to jobs during the period using the predetermined overhead rate is less than the total amount of overhead actually incurred during the period. But over-applied overhead exists when the amount of overhead applied to jobs during the period using the predetermined overhead rate is greater than the total amount of overhead actually incurred during the period. In conclusion, if you applied less than what is actually incurred, then you under-apply overhead. But if you applied greater than what is actually incurred, that means you over-applied overhead. Let's see the overhead application. Peer company's actual overhead for the year was $650,000, with a total of 170,000 direct labor hours worked on the jobs. Peer company's predetermined overhead rate is $4 per direct labor hour, which is calculated as $640,000 divided by 160,000 direct labor hours. The overhead applied during the period will be equal to $4 per direct labor hours times 170,000 direct labor hours, which is $680,000. So the actual overhead is $650,000. The overhead applied is $680,000. So whether it's over-applied or under-applied. The answer is peer company has over-applied overhead for the year by $30,000. What will peer company do? Any remaining balance in the manufacturing overhead account, such as parent company's 30,000 of over-applied overhead, is disposed of in one of two ways. The first way is that it can be closed to cost of goods sold, or it can be closed proportionally to work in process, finished goods, and cost of goods sold. The journal entry in T account form to close out parent company's $30,000 of over-applied overhead into cost of goods sold. See, this is the $30,000 of applied overhead. You can do the journal entry by debiting manufacturing overhead and crediting cost of goods sold by the same amount, which is $30,000. You will close out the manufacturing overhead over applied. You can also calculate the allocation of under-applied or over-applied overhead between work in process, finished goods, and cost of goods sold. Let's assume the balances for these three accounts are as follows. For work in process, that's $68,000, finished goods $204,000, cost of goods sold for $8,000. So you can get the allocation percentages for work in process, finished goods, and the cost of goods sold. 10 for WIP, 30 for finished goods, and 60 for cost of goods sold. The allocation of the 30,000 of over-applied overhead would be 3,000 for work in process, 9,000 for finished goods, and 18,000 for cost of goods sold, based upon the percentage we just get from the previous slide. The next step is to close out the over-applied overhead by allocating these $30,000 to work in process, finished goods, and cost of goods sold. Here is the journal entry. You debit manufacturing overhead by $30,000. You credit work in process inventory by $3,000, finished good inventory by $9,000, and cost of goods sold by $18,000. In this way, you will close out the over-applied overhead. In summary, there are two methods for disposing of under-applied and over-applied overhead. The first one is to close out to cost of goods sold. The second one is to allocate between work in process, finished goods, and cost of goods sold. The second one is considered more accurate, but it is more complex to compute. Let's do two concept check. The first one is concept number 5. Tiger Corporation had the actual manufacturing overhead cost of $1 million to $10,000 and a predetermined overhead rate of $4 per machine hour. Tiger Company worked to 90,000 machine hours during the period. Tiger's manufacturing overhead is which one? Please think about it. The answer is B, 50,000 under applied. Overhead applied is calculated as you take $4 per hour times 290,000 machine hours, you will get $1,160,000. That is the applied overhead. And the actual overhead is $1 million to $10,000. So you have 50,000 under applied overhead. Concept check number 6. If over-applied overhead is closed out to cost of goods sold, what is the effect on net operating income? Increase, unaffected, or decrease? What do you think? The answer is A. Net operating income will increase. The journal entry will include a debit to manufacturing overhead and a debit to cost of goods sold. The decrease in cost of goods sold will increase net operating income. This is the end of Lesson 3 for Cost and Management Accounting, an introductory lesson series. See you soon in Lesson 4.